Bring that ass back like a boom, 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 boom.
Alright guys, so second part of our weekly review, we're going to start with the market internals. So talking about market internals, the first thing I want to talk about is the advanced decline lines. I'm just going to go briefly over them. You know the drill by now, I think. S&P 500, basically the advanced decline line is moving downwards. S&P 500 is also moving downwards. Basically we're seeing the same thing that we saw last week. Advanced decline line is responding to the price action in S&P in a perfect way right now. As far as the QQQ goes, we're making new lows in the advanced decline line, and price is still not confirming, so I say there's more downside to the QQQ. As you can see, the advanced decline line made a new low. The QQQs still haven't made one, and I mean that if you notice right here, just get a horizontal vertical line. If you notice right here, this is the advanced decline line during the big drop, and right now we are seeing that we are lower in terms of advanced decline line, but the price is not confirming that, so I say more downside for the QQQ. At least that's what the advanced decline line is saying. Now looking at Dow Jones rebounded. Advanced decline line made a V-shaped recovery, and it's responding nicely to the price action. So there's no divergence here, and this is the main thing that I'm looking for. IWM, the same thing. This low right here was reflected by this low, so everything seems all right here. Now let's look at the put-call ratio, and volume of the puts have subsided, neutralized, so we're looking at the straight line right now. Again, as I said, we need to hold within these parameters between 1 and 0.75, 0.8 to normalize the action. And as you can see right here in this zone, starting from we have the snap. Let's just remove the snap. So starting from right here, which is right after the COVID crash. This is the COVID crash. This is S&P 500 on the bottom. Right after the crash to about the last time we tested that. I can just move it a little bit forward. Right here. We've moved to a lower range of the put-call volume ratio. So calls have been predominant right here. The normal usually prior to COVID was, as you can see right here, from this green line to the very pale dark green line right here. So from 0.75, 0.8 to about 1. This was the normal range for put-call ratio. Once COVID crash hit and we started this huge recovery, put-call ratio has moved as 0.75, 0.8 being the high level, and 0.5, 0.6 being the low level of the band, which basically is telling us that there's intense call buying. So this was not normal, and now we're moving back to what was pre-COVID in terms of put-call ratio, which is actually good. Now I promised to show you what we are looking for when we are making the risk vest model, those sell signals, and let's start with the advanced decline issues difference. Now what that means basically is you're taking all the stocks here, all the stocks in the United States, and you are subtracting all the declining number of stocks from the number of advancing stocks. When this line is neutral, we say that in our risk vest model, the advanced decline issues is neutral. When this is rising, we say it on green, good signal. When this is declining, we put it on sell or bad signal. Right now, this is a moving average of the advanced decline issues, because the pale green ticks behind it are basically the advanced decline issue day for day. So I've put a moving average here, and as you can see, and I think this is the 34 exponential moving average. It doesn't really matter. Something long enough, 20. You can put the 50. It doesn't matter. You just have to make enough data compressed so you can see it long term and not be distracted by these ticks every day. As you can see, here's the trend line of the data, and it's sloping downwards. So the declining issues, and it's negative right now. As you can see, the reading is minus 1,234. So there are more declining issues than advancing issues, and on top, the general trend is downwards. So that's why we have it on red sell signal. Now, this is the exact same thing, up and down, but we're speaking about volume value in terms of the United States dollars. So basically, if we subtract the value from the stocks going down from the value of stocks going up, we're going to get this number. When this is going up, as you can see from it has been going up for 2021 and for 2020. There were some drops, but for the last majority of 3 months that prior to now, so starting from somewhere in October, November, it started dropping right when we issued the sell signal. This value has been going downwards. Now it's in negative territory. So this is another reason why we have it on sell signal. Now, this is stock participation with the stocks making new highs and new lows in terms of the 52 weeks. So 1 year high, 1 year low. And as you can see, these are moving averages of the real value of the real data. The real data is the pale lines in green, in red. So the green line represents all the stocks that are making 52-week highs, and the red line represents all the stocks that are making 52-week lows. Now, when the green line is above, that means that more stocks are making 52-week highs compared to stocks that are making 52-week lows, and vice versa. So when we issued our sell signal, that was on the 22nd of November last year, you can see that the green line crossed below and the red line crossed above. Only once in January, and I think this is, there's a data that is on the 4th of January, so that's the first trading day of the year. Those two lines touched, and that served like a hot stove for the red line, which exploded again to the upside, and we haven't seen it even close to the green line in the last 3 months. So basically what we're looking at right now is more stocks are making 52-week lows compared to stocks that are making 52-week highs. Compare this to history, and I zoom out a little bit, and you will see this is the spike right here in 2020. Now this is a higher spike, so that meant that more stocks than now made 52-week lows. So there was like a lot of selling, panic selling, but that lasted only a month. Right now we are already 3 months down, which is pretty much like the 2018 and some 2015 crashes, but I think that we beat this in terms of time. So as you can see, all those periods are followed by rallies in the market. So you had this, which is combined arguably like half a year, then you had those three months, then you had this 1 month, but in between, as you can see right here, in between we've had some really positive movement. So hold on there. I think that we're close, and we'll see how this goes, but this is where stock participation comes from. Last but not least, let's look at the moving averages. We went through this complicated chart last time, so I'm not going to go into depth. I just want to show you that we are moving up on stochastics. This is the stochastics, and in terms of moving averages, we are still in a downward looking slope. So nothing really has changed. As you can see here, the yellow and the purple lines, these are the 50 moving average and the 200-day moving average. These are the stocks as percentage above the 50 and the 200-day moving average. We're still around 25%. So 25% of stocks are above their 200 and 50-day moving averages, which is quite minor. Now let's look at the VIX, and then we're going to take a look at the top and bottom industry groups. Last but not least, VIX. Now VIX, the thing that bothers me, VIX here on the bottom side, the thing that bothers me about the VIX is that VIX is on an upward slope. I don't really like this support line right here that is pushing VIX higher and higher. but there's absolutely nothing that you can do. And on top you can see the SPY. The SPY is on the other way around, basically sloping downwards. So VIX is elevated. This environment just speaks to me: be careful, be careful, be careful. Either trade small and fast or just don't trade at all. So with that being said, be careful. As I said, we have our market environment on sell signal. We have our risk vest model on red everywhere. VIX is very elevated, like we have it right now on 32 almost. So we have to be really careful with volatility. Now let's look at the top industry groups. All right, so looking at the top industry groups for last week, we have pretty much oil and energy domination across the board, with two exceptions. This is media periodicals and chemical and agricultural, and this is coming from Russia's decision, or it's basically right now are in talks to hold some of the fertilizer exports, and Russia are a big dominant player in the field of agricultural fertilizers, so hence this is moving the price up. Now, one more thing that I want to look at when we're looking at top industry groups are the notable movers to the upside, and this is a change. This week I've decided to list the top 10 in terms of change from previous week to last week. So these are the companies in order, going from metal production was the highest mover in terms of group movement, and here in parentheses I've listed the top tickers from each of those industries. Now remember, these industries are proprietary indicator of Investors Business Daily, so they have this way of separating them, and I've taken the tickers directly from their separated groups. So these tickers are representation of the strongest symbols following in these industry groups. So for metal and production slash distribution, we have RYI, and we have Zeus. Then we have machinery and farming in second place. We have DE here, which is a notable company. Then we have medical long-term care, and so forth and so forth. We have here on number 5, we have pollution control. Aqua is on my watch list. One thing that I really want to mention here is something that you might be looking forward into the coming weeks is alternative energy is coming back. You saw that some companies like Plug, which is electric charging, 10, which is the ETF DAN, that's the solar energy ETF, they recorded some spikes. So put those on your watch list and make sure you follow them closely, because I think that this is a place where we can see some follow through. You've seen oil and gas, then you've seen coal, and now maybe alternative energy will also pick up, which will be good for those companies. On the other side, the worst industry groups, we have computer, retail, computer, again computer and software. So basically all NASDAQ related is the bottom of performance groups, and here are the companies that have recorded the biggest drops, starting with commercial services, document management. Again, here in parentheses I've listed the top companies in this sector. So we have IRM, ARC, we have transportation and airline. Now these are the two best in terms of, again, Investors Business Daily proprietary indicators companies. So CPI is ZNH. Of course, we have here also DAL, Delta Airlines, we have Southwest Airlines, we have also some producers of airlines like Boeing and Embraer. So take a look at them. Leisure and booking was big last week. We now have some drop, and again, electronics, semiconductors, factory manufacturing, then equipment, and NVIDIA, AOSL, telecom and consumer products. Apple is a notable here. Again, computer data storage, PSTG is a big company. They're also dropping. So this is how the industry groups look like. But as we've already mentioned in our chat, we go by the stocks. So This is a good overview to have, but when we trade, we go by the stocks, and stocks are the ones that are usually leading the groups, not the other way around. Now, let's move into sentiment. This is something that I'm introducing this week because I think it will be an interesting point of view for you guys. It's more like, how to say, the contrary indicator of the market. When we have an excessive bull or excessive bear, this might mean that we're close to an exhaustion point. So these are the bulls versus the bears, and this is first the reading of the bulls. Now I'll explain what this chart means. This chart is basically property of American Association of Individual Investors. This is where this AAII comes from, and these are the readings for the past 20 years. Now this is how much in terms of bullishness the association, the American Association of Individual Investors is. And they have like a survey that they pass along to all the members who fill it. They get it back and they compile this data. So right now we are at about 30.39 bullishness, which is right in the middle of the chart, although this chart has been dropping. As you can see, like if we have a moving average here, you'll see a slight decline. But what is really important here to notice are the extremes. Now, as soon as we hit an extreme, which is closely below 20, and as you can see, 20 is sort of a benchmark right here. As soon as we hit an extreme, we tend to bounce back, and this leads to market bouncing back as well. So this is the anticipation of what people are thinking that will happen in the market. As you can see right here in 2020, that was like the big drop when we had the COVID crash, and now we've went even lower than that. So this is one sort of a counter indicator telling us that maybe the market is coming to a bottom. Of course, this is just one piece of the puzzle. Now, looking at the bears, when the bears are intensely to the upside, when there's like overconfidence in the bears and there are a lot of bears, we get to about 50-55, and then we can expect some sort of a reversal in the market. Now, as you can see, last couple of weeks we were above the 50. Now we've dropped a little bit. Maybe people are anticipating this bounce as we've been talking about. Maybe not, but what's important to note is that we were close to the extreme. So we've been close to the extremes on the negative side of the bulls, and to positive side of extreme on the bears. So basically both counterparties are speaking the same language. One are extremely optimistic, the other ones are extremely pessimistic, speaking of the bulls. And here's another thing that is talking about sentiment, fear and greed index. This is CNN proprietary indicator. I will leave all the links in the description because this is something that you can look at intra-week. Once a week I think is pretty much enough, and I don't really think that they change it. I think they change it like every week. So the fear and greed index, it's comprised of 7 elements. Those 7 elements, I'm not going to go through them. I don't want to make this video lengthy. I'll put them in the description. You can go over them on their website. They have pretty lengthy explanation of each of the component, and each of the component has a rating. You know, ranging from extreme fear to neutral to greed to extreme greed, and then they combine them and give us this ultimate fear and greed index for the entire market. Right now we are at extreme fear, and as you see, 1 week ago we were at fear, 1 month ago we were at fear, and 1 year ago we were at neutral. So right now we are close to the bottom, so to speak. We're 17 points away from the bottom, which is the extremist of fear. So this also is saying to us that, you know, people are very, very fearful of the market, and when this happens, usually we see some bottom in action. Now this is the fear and greed over time. We are close below the 20, and in terms of the fear and greed index, 2020 COVID crash was even lower than now, but this is one of the, well, we have one reading right here and one reading right here that are close to the lows. So basically this is like one of the lowest points we've ever recorded here. And also, as I've mentioned, we have now fear and greed index for crypto, and this is Bitcoin. This is the price of Bitcoin, as well as the fear and greed here in below. This is the reading. So right now we are at 22, and you can see it, the colored dots alongside price. So when we were moving in January 2021, we were moving up. This is the price, 10,000, 50,000. We were moving up. There was like extreme optimism here at the tops, and as you can see, the colors changes and price drops. Now when price hits extreme fear like we are in right now, price usually bounces. Now understand, these are sentiment indicators and they're contrary to what is happening in the market. So when the market is rallying, we have extreme optimism. Everybody's happy, cheerful, and as most of the people are saying, when you hear people, being very happy and very elated about what the market is doing, usually it's a good time to sell. And when everybody's in the dungeons and everybody's like bleeding, this is the time when you want to buy. So maybe this opportunity is right next to us. So lastly but not least, very important, the summary. Risk vest, as I said earlier in the video, I said in the first video, we are on sell signal. The setup, selective to none. There's very few setups that are that have been working, and there are very few setups that are actually setting up properly for us to trade them. Market is in consolidation, and we might actually, if we get more downside, move this to pretty much distribution. The put volume you saw, it's neutral. Basically, it's a flat line right now. You saw it in the put call ratio. The volatility is increasing. So when we're moving to the downside, usually VIX is increasing. And there's some other issues troubling the market, like the geopolitical tensions between Ukraine and Russia, and the Fed rate hikes, which are still not happening, but we're getting some, clues what's going to happen. Although, problem is, again, as we see, some of the Fed members are speaking about 25-point rate hike. Others are saying 50 points will be okay. So we still don't know what's going on. And for the time being, we had this for quite some time now. Cash is king. I really want to change this to go all in, but I can't. I'm sorry. Cash is king for now. We have to be patient. We have to be careful with our investment decisions for now. So as we're saying, just chill. Watch. If you get this really good pitch, you can participate, but for now, just use a lower allocation of your portfolio. Don't be really greedy. Get your profits quickly, and yeah, that's pretty much it. I mean, just be careful, guys. So I will see you in chat, and we'll take a look at some setups that we might actually take. So have a good weekend, and see you soon. Bye bye.